Tax evasion can be legal. Today I'm going to show you how. I guess technically it's really tax avoidance or tax deferral, but those terms are boring. You know what's not boring? Free money. Welcome back to my channel, where I share knowledge that I've gained as a CPA to help you obtain financial independence. Today I'm going to be sharing a detailed example of the tax impact of contributing to a retirement plan, such as a 401k, and what it means when someone says you're leaving money on the table. Putting money into a 401k early in life has so many benefits. The sooner you start investing money in the stock market or a money market account, the sooner the compounding starts. And compounding means that your earnings on your investment start to make earnings as well. It's kind of like your money had a baby, which grew up and had a baby of its own. A traditional 401k is based on pre-tax dollars, and that's what we're going to talk about in this video. A Roth 401k is different, and we'll tackle that in a future video. It's easy to think when you're young that you have a lot of time to do these things. But it's really hard to set money aside when you're struggling to pay your bills, but you'll need to be intentional in your choices. So let me show you why you shouldn't wait. This example is a little bit technical, so hang in there with me. There are other taxes and deductions that impact this in a real-world scenario, but today I've simplified it to show just the federal taxes. The exact numbers aren't as important as the concept. Let's say you make $1,000 gross pay per paycheck. Gross pay is the amount before taxes and deductions, and not the amount that you take home. If you're in a 22% tax bracket, then the federal taxes would total $220. Tax brackets vary based on your individual circumstances, but this is a common bracket, and again, we're just talking about the concept. In this scenario, without a 401k, you would be taking home $780. The second box shows what happens to the tax liability if you contribute 5% of your earnings to a traditional 401k. The 401k deduction of $50 comes out before your federal taxes are calculated, which reduces your gross income to $950. And then the 22% federal tax is only calculated on $950 instead of $1,000. As you can see, your net pay decreases from $780 to $741, which is only $39, but you actually put $50 into your retirement account. It's kind of like magic. This is where the real magic happens. Let's add in the free money part. Most employers have some type of matching for your 401k contribution, which means that for every dollar you put into the plan, they will put money in as well. In this example, they match your contribution at 50%. You put in $50, your employer will put in $25. You've just added $75 to your retirement account, the $50 that you contributed and the $25 that your employer contributed, and it only cost you $39, just like that. The $75 now begins to gain value based on the movement of the stock market or interest rates, depending on what you've invested in. Although the stock market goes up and down, the average return over the past 20 years has been 11% per year. So this is why you want to start early, so that your money has time to grow. That $75, if left in the account for 20 years at 11%, would be worth $604. My advice is to start small, but try to take advantage of the maximum amount that your employer will match. They actually cap this number. The term leaving money on the table means that you did not receive all of the match that you could have. Remember, this is free money, and it doesn't cost you anything. Also, take advantage of the compounding. Don't take money out of this account. Leave it in there to grow. That savings is not easy. Don't wake up 10 years from now in a worse situation than you're in today because you didn't have the guts or the discipline to do hard things. You got this. Go make it happen. Thanks for watching. If you gained information from this video, please share with others and check out my channel for more financial videos.